Good evening, everyone. Just a quick sound check if everything is okay and the video is okay. Good morning, good afternoon, good evening, wherever you're from, and welcome back to our beginners workshop. And from Okta, this is going to be the third part and the final part for the beginners workshop. We are going to be jam-packed with a lot of materials, so get yourself ready. We're gonna kick it off. All right, my screen might flicker a bit. If that's the case, just hang on there, and then it should all be back to normal. Okay, so video okay, audio okay, everything okay? Good. All right, welcome back. My name is Vira Injara, and we're going to take a look at the last part of the beginner's workshop, and that would be the risk management and tools to predict the market. By the way, if you see a flicker on the screen, that's just temporary. It should be back up very, very soon. I'm just having a little bit of an issue with the software to stream, so hopefully that's not going to pop up a lot. Okay, so you're going to see maybe a green screen on your side, but the stream is still going to be okay. Afternoon from Nigeria. All right. So subscribe to the webinar on the OktaFX website and get 100% deposit for your next deposit just for this week's workshop session. Okay. Hello, Pakistan, and hello, Malaysia. Hello, India as well, I believe. Okay. Let's get started. My name is Vira Injaro, and just a quick rundown. You guys have been seeing this. If you guys have been following, if you just join in, this is a little bit of a background, but I'm not going to go too deep into it because we do have a lot to cover. If you're curious, we do have about 70 slides to cover tonight. So there we go. All right, so a little bit about myself. Being a full-time trader since 2004, being a trader mentor. So I've been training other traders since 2007. I've also been working in the industry as a chief technical strategist and a technical analyst for a couple of companies such as GFT and Invas, which is listed in Japan. So yeah, that's my expertise would be in technical analysis. Obviously, my job is strategist and technical analyst. And I use Ichimoku Kinko here as well as Fibonacci trading methods to go through my trading every day. All right. So a little bit of a background here. I've been writing articles in Japanese, Channel News Asia, BBC UK, CNBC, Invest Fair in Singapore, 1FM in Singapore as well, and the ATAA conference. You can look me up on the ATAA's website if you want to jump in on a little bit more of an advanced Ichimoku. If you want to, you can go there and look up my name, search my name if you want to, and it's going to be a video there about my presentation. Other than that, this is the stuff that we're going to cover tonight. Number one is the importance of a trading plan. I'm going to talk about risk factors because we haven't talked much about what's the risk in trading. So there are trade risks, there are capital risks, there's going to be market risks. You need to understand what's the difference between all of these three. And then we're going to go into position sizing. Yesterday, I did some example, not yesterday, on Wednesday, we did some example live on, how position sizing, if used wrongly, it could kind of bite you back. So that's, again, understanding position sizing means correctly understanding the leverage that you're doing and how it applies into your risk management. We want to be able to calculate your position size with leverage, capital risk, and trade risk in mind. And then touching on a little bit about understanding risk to reward ratio. And I do apologize for this flicker. I'm trying to make it go away, but it's just there. Okay. And we're definitely going to be touching on fundamental analysis, which is your key data for Forex market. And there's a really good example on what's happening with the fundamental this week. That would be the FOMC statement that just got released on Wednesday, American time, or early morning Asian time. We did show you how to use the economic calendar. We're going to be showing that again as well tonight, but the focus again would be a little bit more on the technical side. There's going to be key levels in the market that we want to focus on, trend lines and triangles as well. Previous classes are made available. It's actually part of the series. If you go through the channel, it should be on this week's list of webinar videos. So you can review part 1 and part 2 again. We do have bits and pieces that's connected here and there, but overall, it's kind of individual. So you can just review the video again. All right. Let's start with the importance of trading plan, because we don't want to trade without a plan. That's number one. Okay, so trade management must comply with the rules set in our trading plan. So before we even start trading, we want to be able to at least have a little bit of an understanding in how to create a trading plan. I just want to put more on an emphasis in the reason why we need to have a trading plan, because you need to understand that trading relies on probability. That's number one, and it is consistency in managing your risk and adhering to our trading strategies that can make us successful. So you want to be successful in trading, make sure you have a trading plan. It can be a simple trading plan. It doesn't have to be really complex. You can always start small and start simple. But it's just a matter of consistently following that trading plan, following the rules of that trading plan, and you don't want to just switch things around when you have a trading plan. I think that would be the key differentiator in how people are successful in trading or whether they're gonna fail in trading. All right, it's a matter of consistently following what you set out before you even start trading. Okay, so definitely you need to have a definite plan before entering a trade. That's obviously there. So when creating a trading plan, what you need to remember is not to think about the profit, but the risk limit. Okay, you need to limit the risk that you have, and then you need to know your exit, which is your target levels, before you enter a trade. And the reason is you need to know how it is if it goes bad, and how much are you gonna gain if it goes right. Okay, and that would be your decision making process in terms of whether or not you're going to enter into a trade. Okay, so again, I cannot stress this enough. Successful traders are those who are well prepared for all possibilities before opening a position. We touched this on the stress management side or the trading psychology side, but we really touch on a lot about you accepting the losses as well as gains when it comes to trading. Okay, so again, I'm trying not to look into the Q&A side that you guys are posting right now. Feel free to post it, but I'll leave it until the end of the session before I start answering all those questions. But if you do have a question, hang on tight, and I'll be answering those questions at the end of the session. We just have a lot to get through because we're going to be covering fundamentals, we're going to be covering technicals today. So this is more of a jump start to get you up and running after this workshop. All right. So the reason why what went wrong is when you don't have a trading plan is you don't know whether if you're wrong or if you're right, and your profits can turn into losses very quickly because your your exit point isn't clear. You might be able to enter a position, you might know your stop loss, but you don't know when to get out, and that is the biggest problem, right? So setting a limit to yourself in terms of when to get out, how much you want to gain in the market, how much you want to risk in the market, I think that's really important. Much more important than getting the best entry. There's no such thing as the best entry. All entries are good if you have a solid exit strategy. When we talk about exit strategy, that would be your stop losses. That would also be your target levels. Okay, you don't want to try and change your trading plan or analysis halfway through, because that would mean you don't really have a good solid trading plan to go in the first time. So after your trade is executed, control of a trade is no longer in your hands, other than adjusting stop losses according to your trading plan. So if you do create a trading plan where a market goes up to a certain range and you're profitable, you want to lock in those profits, or you want to move your stop loss to break even, and if that's part of your trading plan, you can do that. But if you're just removing stop losses just because it's gonna hit your stop loss and you don't want to take that loss, and you start lowering your stop losses or increasing your stop losses, that means you don't have a trading plan. Okay, so be clear on this one here. Ideally, what you want to train yourself to be is that after a trade is executed, you already have your stops, you already have your target levels, and you're just letting the trade runs. If it goes according to your trading plan, that's fine. If not, then you need to take a look at your trading plan. Is it part of the probability that you have tested? Or if you are consecutively wrong, then maybe you want to look at another trading plan, or maybe trying to fix what's going on there, whether it's your timing, maybe it's a currency pair that you're trading, or maybe it's an instrument that you're trading that's not really suitable to your trading plan. Just to give you, this is probably going way ahead, but typically trading strategies are divided into two. One is used during a trending market. The other one is used during a sideways market. A good trader will always have at least two trading plan to trade this two separate market condition. Sideways condition is where the market is just ranging, and trending market is where the market just starts going up and constantly moving upwards. That's an uptrend or a downtrend, which we're going to touch on later on. All right. Now, if there is no trading plan, the problem that we have that's going to impact us emotionally is that we start hoping. So hoping, it's good in a sense as we are conditioned to hope, right? I mean, a human being is always conditioned to hope. We hope that all the plans go well. We hope that this is going to happen. If we hope that something good is going to happen, we don't hope for something bad to happen, right? But this, when it comes to trading, is actually the worst emotions in trading, because hope can quickly turn into a sense of satisfaction or a sense of security. You're really hoping that the market is going to turn around. You're really hoping that your targets are going to get hit. That, it can be a positive or bad thing, but regardless, it's an emotion, right? And we don't want to have this emotion when it comes to trading, because this will cause a trading bias when we hope the market is going to go up. But in reality, we can do an analysis on the market, and the market is actually doing a reversal, and we thought, oh yeah, it's still just going to go up. All right, so we hope that it's going to go up. It's going to create a trading bias in our system, and that's the problem with a lot of traders. So when you start hoping, or when you start doubting your trades, most of the time you may have been wrong. So you need to review the situation and the market conditions as quickly as you can, and if necessary, immediately cut the position. This was a question asked yesterday. I believe there was someone asking when to cut your position, and I can tell you straight away, if you have this emotion when you start hoping for something to happen in the market that doesn't really goes along with your trading plan, then you probably need to cut your position and then review what went wrong. Okay. Without a trading plan, you'll also be taking small and quick profits, but let losing trades run. Some of you that has traded before probably can comply to what I'm saying here, because this typically occurs when there's no trading plan, and it'll only take 2 consecutive losses to cause fear, doubt, and therefore it will have a psychological or mental impact on a trader in the long term, and we call this a psychological trauma. Or to be specific, there's a term called loss aversion that we discussed in a trading psychology webinar. So yeah, it'll only take 2 losses to create fear and doubt and damage your psychological or mental state when it comes to trading. So trading must be considered as something systematic. Systematic being it's not objective. It's not subjective, but it's very objective. You have a solid strategy to get in and out of the market, and that's what you want. So think of a trading plan as a blueprint or planning of a trade, and it is a necessary part of trading. Okay, so we haven't touched on a lot about this. We only touch on some of the fun stuff on Monday and Wednesday. So tonight we're doing a lot of the heavy stuff on the risk management side. All right. So risk factors in trading. So there are three different risks that you need to consider. The first one is capital risks, the risks that have an impact on your capital or account equity. This is included in money management risks. Okay. Calculation of the maximum lot size to maintain equity and margin level. We talked about margin level. We talked about your equity yesterday, not yesterday, on Wednesday. Why do I keep saying yesterday? Because we used to run this 3 days in a row. Okay. All right. So that's capital risk. Is anything or any risk that's immediately reflected on your capital or on your total equity. Then we have a trade risk that's separate. This is a risk that's directly related to a trade. So if you're taking two trades, you have two trade risks that you need to consider. Okay, this would be also included in the risk management of a trade, specifically in the entry and exit part of it. This is where it comes into play. Stop loss, take profit levels compared to the entry will become your risk to reward ratio, which we are going to touch on later. What is a risk to reward ratio and why do you need it? Okay. And then market risks. These are risks caused by economic, political, and geopolitical factors. And if you are curious, something happened this week. That's the FOMC statement addressing the inflation situation in America. And as I mentioned before, this was just released on Wednesday in America. Very, very early morning in Asia. So depending on your region, you might see how the price movement on the euro and the pound in the past 2 days that was impacted by a fundamental news that came out. That was the FOMC press conference that basically talked about inflation, which we're going to cover a little bit later on during our fundamental talk. All right. Okay, so here are your risk tolerance and risk to reward ratio. So this is something that it's more of a template. It's not a definite thing. This is something you need to take into account when it comes to trading, and you need to answer this yourself because I cannot answer this for you. If you have a low risk tolerance, then you are going to be looking at 0.5 to 2% risk to your account. Medium is 2 to 5%. Anything above 5% that's reflected on your capital risk, I would consider that a high risk tolerance. So it will depend, and your strategy is going to depend on your risk tolerance. Risk tolerance basically means how well do you cope with losses. Okay, risk to reward ratio. If you are a low risk kind of guy, then you typically have a 1 to 3 long risk reward ratio. That means for every dollar lost that you're willing to risk, you want to get $3 back. Okay, and this is going to put you in a position as a long-term trader. Medium risk is probably where everyone is going to be. It's between 1 to 1.5 to 1 to 2.5. All right, so it's much more reasonable. You're risking $1, but you want to get $1.50 back. Risking $1 to get $2 back. Risking $1, you want to get $2 back. I think that's okay. It makes sense. High risk, it's either 1 to 1 or maybe 1 to half. Okay, so some scalpers or intraday traders, they might be risking $5 to get $2 back, for example, or $10 to get $5 back, and it's okay. It's part of their trading plan. So again, this is gonna affect how you do your trading plan. How do you manage your risks when it comes to trading? It does has a lot to do with how you can tolerate risk, how much you are willing to take a risk on, and also what kind of risk to reward ratio you're aiming for. All of this plays a huge part when it comes to your risk management. Okay, so the reason why we need to look at risk to reward ratio is that you want to know your potential profit targets, and then you want to estimate your likelihood of being right or being wrong, either with fundamental or with technical analysis. You basically want to know how much you are at risk before making a trade. See, there's a difference here. A lot of people are gonna tell you, "Oh, just open a trade first and I figure out what's gonna happen next," right? That doesn't apply if you are gonna be following what I'll be doing. I have a strong emphasis on calculating how much you are going to risk, okay, how much you can actually lose, and then how much can you actually gain before deciding to whether or not I want to take a trade on. If the risk to reward ratio doesn't meet my criteria, then I'm just gonna leave a trade, even though a lot of people are gonna be saying, oh, you're gonna be missing out a lot. I don't really care, because to me, if I'm not comfortable risking this much and I want to know how much it is, then I'm not comfortable taking the trade. Okay, so this is kind of a reverse psychology to a lot of people that kind of train traders out there. All right, so I always find out the exit first. To me, the entry is irrelevant. If I'm not comfortable with the risk, then I'm not gonna take that trade. But if I'm comfortable with the risk, then I'll fine tune my entry. Otherwise, I'm just gonna skip it. Okay. So use a stop loss and stick to what was planned in your trading plan. Again, this is open for discussion because a lot of people have different trading plan. For example, I have a habit of moving my stop loss to break evens and then letting my trade run after a certain limit has been reached. That's just part of my trading plan, okay? And I always have 3 targets when I open a trade. I have target number 1, number 2, number 3, and I'll be scaling out of the market, a term which we will touch on later, okay? So 2 things you need to remember is that you need to cut your losses and you let your potential profit run. Don't just take quick profits because you are afraid that you're gonna lose that profit. That's basically what happens when you don't have a trading plan. When you do have a trading plan, then you are able to cut your losses and you are able to have the confidence to let your profit potential run. So manage your losses first, and the potential profits will manage itself. That's what I can share with you, and this is me, someone that's been trading for 19 years, right? I can tell you straight up, if you consider or manage your losses very well, the profit potential is going to take care of itself. Okay, how many consecutive losses or drawdown can you take? This was a question that was asked, whether or not I should be following someone's strategy. Someone could be very profitable. Someone could have a high percentage gain in terms of their returns, but they could have a high drawdown as well. So the higher the drawdown, the more dangerous it is, the higher risk it's going to take. So you can convert risk percentage into risk cost. Example, 3% risk on a $10,000 account would be $300 risk per trade, and you don't want to risk more than $300 risk per trade. The percentage will change for every trade. This is not fixed because every strategy is different. We are talking about trade risk, your trade risk on the Euro USD and the GBP USD. The GBP USD is definitely going to be bigger than the Euro USD, okay? So how many consecutive drawdowns can you get? You basically want to divide your cost of risk by account equity. That will be the equal number of losing position or losing trades that you can take, excluding the margin, okay? For example, 10,000 divided by 300, you can take 33.3 trades and you can lose 33.3 trades before you're out of the game, okay? This is the number of drawdowns based on trade risk only, and trade risk in this example remains constant at 3%. Again, this will change. Some trade risk will be 2%, 1%. That would be really dependent on how you want to do your trading plan. All right, I'm going to hide this a little bit so you can read the bottom part. In advanced risk management, it is required to factor in capital risk in combination with trade risk to achieve a much more realistic drawdown limit. So this is, to a lot of people, this is the first time you're going to hear drawdown. You basically don't want to have a high drawdown. The higher the drawdown is, that means the riskier your trading plan is going to be. Okay. So guys, any questions that you need, feel free to type it in. I'm going to answer it at the end of the session, but I just need to go through a lot of the contents tonight. Okay, So let's talk about leverage and over leverage. Again, as I keep mentioning, leverage is a really great tool for trading, but it is not a tool to get you rich overnight. And please, this is the third session. The guys that have been following this for the third time this week, by now you are probably you probably get it that I have a different view on leveraging. It is definitely not a tool to get you rich overnight. So if you think that you're just gonna put in $100 and it's gonna turn into 10,000 in a week, that's not gonna happen unless you're super duper lucky. But probability of that happening is it's really small, and that's one of the main reason why a lot of people actually the percentage has actually improved. A lot of people back about 20 years ago, about 95% actually is not gonna make it in the forex market. Right now we are down to 60%, so we have about 35 to 40% gain in terms of how people, the survivability rate in trading. And because a lot of people are just more educated. Back when I first started, we don't have a lot of this education. We have to learn it by trial and error. Okay, so you want to manage your position size based on capital and leverage. So giving you an example, I'm gonna take an Aussie 200 trade, for example. Okay, I have a capital of 5,000. I'm leveraging it 1 to 200. Let's say Aussie 200 is at 4,000. It was at 4,000. It has gone up. One lot is basically $1 a point. So margin required for one lot is 4,000 times 0.5%. It's $200. Therefore, my available equity is 4,800. 4,800 on a one lot size means 4,800 point in a US 200, Aussie 200. And look at the example here. The Aussie 200 is at 4,000. So technically, I cannot lose in this trade if I maintain this position. Okay, because after my margin requirement, I still have an available equity of 4,800. And for me to lose 4,000, I mean, still have 800 left, 1,000 left. It means the Australian 200 or the ASX 200 in Australia has to collapse and cease to exist, which is not going to happen. All right. So you got to take a look again. Your daily average movement for Aussie 200, which is about 60 to 80 points. Again, this is going to apply if you're going to be looking at the GBP USD. What is your daily range? Normally, you need to measure that. Every pair is going to be different. So that's why I say your trade risk is going to be different from trade to trade. Okay. So if I have a maximum risk per trade, that's about 2 to 5% of my capital. Therefore, 5,000 times 2% is $100. So I'm only risking $100, allowing 100 points to move against my position if the position size is one lot before I get taken out of the market. So I'm willing to risk, look at the table right now. I'm willing to risk $100. If I have one lot size, I'm allowing the market to move 100 points before I get taken out, right? But if I start increasing my lot size just by one more, then I only have 50 points before I get taken off the market. And if I over leverage it and I trade a bigger size, a 10 lot size, it'll only take 10 points for my position to be stopped out because I don't want to risk more than $100. Okay, so this is what I'm talking about when it comes to risk planning. You need to understand what you're dealing with. You need to understand what instrument you're dealing with. You need to know how is the range. Okay, I mean, if ranging 60 to 80 points, I'm risking about maybe $60, $80 potential, and I'm willing to risk $100. That makes sense. But if I start increasing my lot size, it's not going to make sense anymore. Okay, so feel free to screenshot this. This is going to take a while for you to sink in, but this is going to explain everything in terms of how to leverage properly. Okay. So again, I keep mentioning the word sudden death for the past two sessions. Overuse of leverage means you have no control on the speed of the market due to overuse of your leverage and transaction cost of high leverage. Okay, most traders don't see it coming. When they do, it's already too late. Likely your account is going to get a margin call when you see it coming. higher leverage doesn't just amplify your losses, it has also amplifies transaction costs as a percentage of your account. So keep that in mind as well. So leverage used correctly is a very great tool, but using properly, it'll just empty out your account, like the example we did on Wednesday. So if you guys missed out and you just jumped in on today's session, review the second part, because I did some example on opening up huge position size and how quickly it kind of demolishes the account. So that would be on the previous webinar. All right. Margin requirement formula, if I never mentioned this, against your trading cost, required margin is basically your trade size divided by your leverage multiplied by your account currency exchange rate, and that's about it. Again, I apologize for the flicker, and hopefully it doesn't happen too often. Okay, so all right, hold on a second. All right, trade size. If you forgot, yesterday we talked about standard, mini, micro. Standard lot is $10 a pip estimated. Mini is about $1 a pip. Micro is 10 cents a pip. Your leverage roughly that's being used is 1 to 100, 1 to 200, 1 to 400, 1 to 500. Account currency exchange rate could be in USD, Euro, GBP, or JPY, which is your counter currency rate. Okay. All right. We talked about this. Showed the calculator yesterday. Let me see if I can pull it up, but otherwise I already took a screenshot here. Okay, looks like I'm freezing. Okay, we're back on. So your margin requirement on a leverage of 1 to 200, you can find this on the website under calculators, trading calculators, under margin calculator. This is the example that we did yesterday, so I'm gonna skip this quickly because we already covered this yesterday. But this is where you can play around with the calculator and find out how much you're risking per trade, what is the required margin per trade. Otherwise you can always calculate it manually, but there is a tool for it already on the OctaFX website, so you can do that there. Okay, so it changes. If I change the lot size, this is on a standard lot, 610 is required on a leverage of 1 to 200. 0.1 or a mini lot, it's only $61. That's a huge drop. Same leverage. And on a micro lot, it's only $6.01. So $6.10. I'm sorry. Okay. On a higher leverage, obviously you can see the required margin is just gonna shrink. So the higher the leverage, the required margin is gonna get smaller and smaller. But again, your gains could be bigger. Your capital is going to be at risk as well, because your losses are going to be big as well. Okay, so that's the importance of position sizing. Very few traders actually realize the importance of a balanced position size in a portfolio, and traders often make the mistake of ignoring the size of their trading account when taking a new position. So the example given yesterday, when I open up different lot sizes, you guys can see how quickly it can decimate my account on a different lot size, from a standard to a mini to a micro lot. You guys can see how quickly it kind of destroys the account. All right, if you don't kind of calculate your position size, as a result, you are going to become a high risk traders without you knowing it, and as soon as and soon find themselves in deep trouble in terms of the size of the positions taken and the imbalance with their own capital. By the time you realize that you open up too big, then it's already wrong. So you understand position sizing properly, because its main and sole purpose is to protect you by limiting capital losses. Okay. So the golden rule of position sizing to me is never risk more than 2% of your trading capital in a single trade. So if you are doing one trade, don't risk more than 2% or more than 5% of your capital at a time. I'll be honest with you, the 5% limit here, I'm a little bit more flexible. I can increase it to 10%. That's just because that I have a risk tolerance that's up to 10%. But this 10% could be, you know, 5 position. That's not risking more than 2%, right? 2 times 5, I'll get my 10%. So my limit is 5 position, risking no more than 2% of your capital. That way I can still maintain my 10% risk on my capital. Or if you want to start out, you want to experiment, don't risk more than 5% of your capital. You only start increasing this the more, you know, as you go on, as you have a lot more experience and you're more acceptable in terms of taking in your losses. Okay, so here a position sizing formula. If you want to screenshot this, that'll be great. It's basically your equity minus margin required multiplied by maximum capital risk percentage. Equity minus margin required times maximum trade risk percentage. This is your position sizing formula. So you can choose to use all of the maximum capital risk in one trade, or split the position using the maximum trade risk and not much more than the maximum capital risk, like I just showed. I just talked about just now. You know, I can risk 10% against my capital. I want to open up maximum of 5 position. Each position doesn't take more than 2% of risk towards my capital. So in combination, I have 10% risk against my capital, and that would be the maximum limit that I impose on my trading. Okay. All right, so just a quick example on position sizing. This is example A on Euro USD. You got your equity at $50, leverage of 1 to 200, maximum capital risk. Okay, we just explained that. 1 pip standard lot is 10, approximately subject to change depending on the currency pairs, but we'll just take 10 for example. 1 pip mini lot is 1. 1 pip micro lot is 0.1. Now I have an equity of $50. That means I cannot even open a mini lot because the margin required is already 61.03. So mini lots with equity 50 are not able to trade mini size due to insufficient margin requirement. That's a given because I only have $50, and to open a mini lot size I need $61. That doesn't click, right? So I can only trade with micro lots. So if you're starting small with $50, $100, do take this into account. We discussed this yesterday as well, but I just want to put a lot of emphasis on this one here. Now, if your micro lot has a capital risk cap at $2.10, okay, that's a maximum of 21 pips in total for the market to move against that position. So 21 pips is not a lot. If you're thinking, oh, 21 pips, yeah, that's fine. 21 pips when it comes to real life trading, it's not a lot, so keep that in mind. Okay, example B is if you have 500. Okay, now you can start to trade mini size because you have sufficient margin, but you're not sufficient enough to open up a standard lot because it requires 610. You only have 500. So again, example here, if you do trade this on a mini lot, okay, $1 a pip, you only have about 21.9 pips in total before it hits your risk. But if you drop it down to micro, you can actually allow the market to move 246 pip against you, and that's a much more preferable way to trade because you're giving market some movement. You don't want to restrict the market because you cannot predict, and to be honest, giving a market 21 pips before it hits your stop loss, that's just not enough in a lot of cases. Okay, so we're going to talk stop loss and profit target planning. Find out what distance of your stop loss or profit target is. Determine your position size. We talked about this just now. Calculation of how much you made or lost per point per pip move. The distance between your entry to stop loss multiplied by movement per pip is your risk. Okay, simple as that. Now, I keep putting an emphasis on calculating your exits because a lot of traders often focus on the right entry at the right price at the right time. That's sure, entry is important, but it's not super important. What determines success in your trading is discipline, number 1, planning, number 2, and getting out of the trade, which is the key. So if you don't know when to get out of the trade, when we say get out of the trade, get out of a good trade, a winning trade, or a losing trade. Because oftentimes you have a winning trade, you don't know where to get out, or you start getting greedy, then you could get out with a loss. That's just the reality of things. Okay. If you don't know where your stop loss is, sometimes you can get dragged on and you could lose a lot more than you actually planned. So that's why calculating your exits is a lot more important than calculating your entry. So until the moment you enter into a trade, you are in control. After that, the market will dictate where the price will go. You don't actually have a lot of say. You can't actually tell the market, hey, you go up now, or you go up down. Okay, it doesn't work that way. Once you click on a trade, the market does the rest for you. So you cannot control that part. Just as you cannot control with 100% certainty what amount of gain or losses that's going to be made, but at least you have your limits, and that's going to be built into your strategy. Okay, so what you can control is to minimize your losses, protect your profits, and this is done through a defined exit strategy. When we talk about exit, it's always two things. It's always stop loss and it's always a take profit level. Okay, there's always two things to an exit. All right. So with a trading plan and careful calculation of position sizing, the risk of taking a trade can be calculated. All right, some of you guys are probably yawning right now. You guys are getting bored. This is not interesting. All right, this is probably going to be the most important thing when it comes to trading, and I know this might not sink in right now because I mentored a lot of people, and a lot of people just find this part boring. We're going to get into the exciting part later on, but this needs to be there. This needs to be your foundation when it comes to trading. Okay, so look for an exit that matches the capital limit. Remember, you have the limits in your trading capital and also the trade risk limit that we have previously determined in our trading plan. Once you really have that, then you do have a trading plan. Okay. All right, ideal exit strategy should do three things. Number one is to minimize your losses, to maximize your profits, and to limit amount of profit you give back to the market. Meaning the market, you could be very profitable, you don't have an exit strategy, you kind of need to get out of the market before it reverses and you give back your profits to the market. So the point is, do not overstay a position because of greed, and also avoiding entry because of fear of previous failures. We are going to talk about this in depth in trading psychology. This is called loss aversion. If you want to Google it up, you want to learn about it, you want to prepare yourself, it's called loss aversion, which is different from risk aversions. Okay, so there is an economic term called loss aversion, and this is basically that. Previous failures is going to affect how you're going to perform in the future. Okay, do not overstay because you are greedy, because you want to achieve something. Because I was a victim of this. I got greedy and I got my first margin call, and that's very hurtful. All right, the purpose of position sizing is therefore to alleviate factors beyond our control, such as unexpected market movements, like the FOMC press conference. It's kind of expected, but we don't know where it's going to go. Or our mental failure to handle past losses that may have caused trauma. Okay. All right. All right. That's the boring stuff. It's all gone. It's all past. Hang on. Stay here with me. We got past of the boring stuff. That's the risk management part. Pat down. We're gonna go into fundamental analysis. Okay, we're going to talk about microeconomics, monetary policy, and fiscal policy. We're not going to talk about fiscal policy, but we're going to focus a lot more on the monetary policy, because that's basically what the central banks do, and that's how, with interest rates and how they affect currencies. Okay, all right, I'm going to hide my camera so you can take a better look on what's on screen. Okay, key economic data in Forex. Number one, retail sales. Okay, I want you to pay close attention to what retail sales do and what core retail sales do. I want you to pay close attention to CPI numbers as well, because that's basically what's been happening in the past 2 weeks, building up to this week's FOMC statement. All right, what is retail sales and what is a core retail sales? Basically, retail sales is your spending on customer retail. So this is a quick crash course on economics. This is Economics 101. Spending on consumer retail, this includes your clothing, expenditure, the department stores, how much they sell, food and beverage, electronics and equipment, furniture, gas station, car dealer, including car sales. All right. Core retail sales data exclude cars and petrol because core retail sales basically remove the volatility caused by gas prices or oil prices to those non-Americans here. And high ticket item sales like cars. Okay, so if you take away cars and price of oil or people fueling up their cars, then we get what we call the core retail sales. Okay, so it's a very stable, much more stable number than just the retail sales. A decrease in retail sales will basically result in a decrease in the GDP or gross domestic product due to a decrease in purchases and a decrease which is equal to a decrease in taxes received by the government. A drop in retail sales means people are saving their income, and this is an early indicator of employment numbers. Okay, the reason why people need to save up is probably because they don't have a job or they are afraid they're going to be losing their job. Okay, or they're not getting a salary increase, for example, and people just want to save. So the saving mentality is going to cause a drop in retail sales. And this means an economy is going to shrink. Okay, if they spend a lot more, retail sales goes up. So does the inflation, because that means the economy is growing. And inflation in the market as goods becomes more expensive. As goods becomes more expensive, therefore we can indicate that the standard of living has gone higher. That means we have an inflation. That means people are spending more. Okay, that's going to affect the interest rates. Okay, too high of an inflation is sometimes not good, especially in the current case. We do not want to have a high inflation because right now what the global economy is looking for is a steady recovery from the COVID-19 pandemic, and a higher inflation than expected is going to cause problem, and that's basically what we're seeing right now in America. All right, next is CPI. This is the Consumer Price Index, or what we call the inflation guide. Okay, this is basically the measure of the price of basic necessities. What's included in here, what comes with this is also the CPE index. Typically, you don't see CPE index. PCE, purchaser consumption index. Okay, purchasers consumption expenditure. You don't see the PCE normally, but this was mentioned in this week's report from the FOMC. But typically our guidance would be the CPI. If we say retail sales, then we're going to think about CPI. CPI means the higher the CPI numbers, the higher the inflation is going to be. Year-on-year data is used as a benchmark, but quarter-to-quarter data is used as an indication of potential changes. Okay, employment numbers. If you're new to Forex, this is probably a good wake-up call to you, that a lot of people say, oh, trade the NFP. Do not trade the NFP if you don't understand what you're doing, because the NFP is probably the single most volatile news that could affect the currency market. Okay, this is basically your non-farm employment rate. That means you see an increase or a decrease in the number of employment in a non-farm industry. So any industry excluding farming, this would be your non-farm payroll. Okay, this is your non-farm employment rate. This is different from unemployment rate. If you see an increase in employment rate, that means a lot of people are working. Unemployment rate should go down. Okay, so it's inversely correlated. So this is going to get released every first Friday of every month, even on a Good Friday. This year it happens on a Good Friday. Worldwide market are closed for a Good Friday, but the data still comes up. Okay, this is the most volatile news release in the currency market, and it is not for beginner traders. If a lot of people are saying to you, "Oh, trade the NFP," I made a lot of money using because I was taking advantage of the market movement during the NFP. Well, maybe they just got lucky. Okay, this is not for beginner traders. Try to avoid NFP until you're comfortable and understand how it works. What are the patterns? We actually do have a special separate webinar to talk about NFP and how to trade NFP, okay? Because you really need to have a good understanding of market behavior during the NFP to successfully trade it. Normally sees an increase in spread and execution level due to volatility. Sometimes you cannot get out of the position because the liquidity just dried up. Sometimes you see a lot of huge spikes that's going to take out the stop losses. This typically happens during the NFP release. All right. Next is manufacturing numbers. This doesn't really have a lot of impact right now, but considering that the global market is looking for an expenditure in the economic growth, then obviously manufacturing comes into play again. We have the manufacturing PMI or the Purchasing Managers Index, the manufacturing sector indicator, which is the ISM, manufacturing PMI, which is US from the US, and this is mostly monitored by a lot of traders. You read this by looking at the numbers that comes up. If it's at 50, then it's at the neutral limit. If it's at the above 50 level, then you see an expansion in manufacturing sector. That means there's a demand for something in the market, and that's why they start manufacturing more and more. If you see less than 50 it comes up, then there's going to be a contraction in manufacturing. So again, this is part of a leading indicator used to predict recession or expansion of an economy. Okay, recession or expansion, not economic growth. So very, very different terms there, but just keep that in mind. Okay. All right, interest rates, probably the most important thing right now. I can tell you right now, globally, we're not going to be seeing an interest rate hike anytime soon, contrary to what the market is saying. Typically, interest rate hikes only happen when inflation gets out of control, and that's one way of controlling inflation. The Fed's press conference, or the FOMC press conference, has indicated that the earliest time they're going to be doing an interest rate hike, that will be in 2023. And in 2023, they are going to do that 2 times, most likely 25 basis points and 25 basis points. But we still have a long way to go to 2023. We are only halfway through 2021, so anything can change. Okay, so again, interest rate is basically your central bank interest rate outlook, or your could be global. This is basically related to your interest rates. Okay, it has a huge impact on government treasury bonds, and in turn, it has a huge impact on the currency of that country. So the change in 10-year bond yield curve is basically a leading indicator of a country's economic turnover, normal, flat, or inverted. The US yield has been inverted. That means price goes down, yield goes up. Price of bonds goes up, yield goes down. This week we see a hike of about 0.5%. Might not seem big, but it's huge when it comes to yield. Because the stronger the treasury yield is, the stronger the currency is going to be. That's why you see the US dollar gaining momentum after the FOMC press statement, because it kind of reflects what's going on, or the scare in inflation that's going on right now. It's just that this is the case study that we want to talk about. The inflation rate is higher or growing faster than what the Fed, so the central bank, is expecting in America. The unemployment numbers is not stable. We have a drop in retail sales in America, but inflation number keeps going up. The US Treasury yield keeps going up. The US dollar gets stronger. FOMC has already accepted that there is an inflation problem, because right now they're looking for economic growth, and economic growth with people that are not working, and means a lot of people are unemployed, and inflation goes up, means a lot of the basic necessities are going to get expensive, and that's going to slow down the economic growth. Okay, that's the problem that's happening this week, and that's the problem that we are going to talk about in the coming months. Okay, so to put it simply, if you have a decrease in your interest rates, that means your currency is going to get weaker as well, because import prices is going to rise, and that's going to have a huge impact on your gross domestic product. An increase in interest rates strengthens the currency because your export prices is going to rise. You're going to earn a lot more by exporting stuff if your currency is higher. Okay, so again, treasury bond yield curve are normally negatively correlated to bond prices. An increase in US treasury yield, which is what happened this week, it leads to strength in the US dollar. Okay, so if you take a look at the Euro USD and the GBP USD, it's been on a steady decline. Okay, so finally we come down to GDP. You probably heard of GDP before. This is gross domestic product, measure the level of economic development or contraction of a country. This is kind of like a tag or a price tag on economy, how healthy an economy is. This is basically an economic valuation of a country. It measures the standard of living of a country. If the GDP is high, then it means the standard of living also increases. Okay, so GDP is a combination of consumer spending, government spending, business capital spending plus net export, which is your exports minus imports. Okay. Previously, before the pandemic happens, 2 quarters of GDP depreciation is classified as a technical recession. So if you read the news and people are saying, oh, the US is facing technical recession, it's because there are 2 consecutive contraction or depreciation in GDP. Now, the economy has changed. Okay, the pandemic happened, data collection happened. The way consumers spend, they're not doing it through normal retail stores anymore. They're doing it through online, which is not really recorded. So America in specific, a lot of other countries has also adopted this. Some regions in Asia hasn't adopted this, but in America, 2 quarter method of establishing a recession hasn't been adopted anymore. So most countries are moving away from this format following the COVID-19 pandemic, because it kind of affects their GDP in a huge way. So it's not really a reliable measure on 2 quarters saying that the market is in a recession. Okay, so the technical recession part, that's what we used to look at. Nowadays, after the COVID-19 pandemic, it's different. We don't look at it that way anymore. Okay, so this is let me just hide my face again. So this is on Euro USD versus the German 10-year bond, and you can see the euro is actually the purple line, and you can take a look at the bond price there. It kind of moved the same way. So so you can actually use a bond price to kind of predict what's likely going to happen, or the currency likewise. But it's typically this: if bond prices falls down, then the currency, it kind of follows suit. This is the yield, by the way. Okay, so this is dollar yen versus $10 US 10-year bond. You can see that it's kind of like moving in the same direction. This is positively correlated, although sometimes you'll see that it's negatively correlated as well. That's where something went wrong, and you need to take advantage of that when it happens. Okay. Now we're talking about volatility next, before we touch on more on the technical side. So get rid of the fundamental stuff first, okay? Can I bid when the price is low and ask when it's high? Yeah, I think that's, Jeffy, that's basically the whole point of trading, if you are selling it, okay? All right. Take a look at the hubs here. We basically have a couple of main hubs. We have the US hubs, which is New York and Chicago. Europe, we've mainly focused on the London and Frankfurt. And also in Paris, the CAC 40, DAX 30, FTSE 100. Southeast Asia is typically just reserved for Singapore index. Malaysia and Indonesia, unfortunately, are not, because we are not considered, mature enough as an economy. Asia Pacific region, Sydney is the main focus. In Asia, it's Tokyo and Shanghai, but Shanghai is a special region, so a lot of people are just focusing on what's happening in Tokyo. Okay, these are your hubs. So I haven't talked much about volatility. So what does volatility do? Volatility basically move the market. No trader means there's no volatility in the market. And we as a trader, we want a high volatility. An investor doesn't want a higher volatility because they want stability. Okay, high volatility means the price is not going to be stable. And then there are regions called dead zones. We're going to cover this in the US Open or UK Open. But Asian sessions, you don't want to be trading European currencies during the Asian sessions because it's a dead zone. It doesn't really move. Asian currencies, again, there's a dead zone after the Asian market closed and after the European London the 2 hours after the Europe or London market opens, it's considered a dead zone. Okay, so there are some rule of thumbs in terms of volatility. When the market open, volatility increases. Okay, if the market overlaps, for example, the tail end of the Asian market overlaps with the the European Open, then there's an increased volatility. When the European market overlaps with the US session, then there's also an increased volatility. So the more the merrier. Market close during the holiday, that means there's an absence of volatility or exaggerated volatility. So that's why you need to pay close attention to economic calendar, because it'll tell you what markets are closed. Okay, just for example, this week, I believe Monday, the Australian market was closed for Queen's birthday observation, so there's a decreased volatility in the Australian markets. Okay, so you want to be looking for relevant financial hubs to trade an instrument. For example, trade the Australian US dollar during the Australian market session. It just makes sense, right? You trade Australian dollar during the Australian market session. You have a better probability of being correct when you trade the Euro USD during the European or US session overlap. So right about now, okay, that's where the European session and US session overlap, which is right now. Okay, if you guys are curious when the US Open is, it's right now. Okay, like literally right now. Okay, so whatever time you are right now, you want to remember this minute here right now. This is when the US market opens. Okay, volatility will also increase with uncertainty. This is typically going to happen during the major news releases like the NFP, like the FOMC statement yesterday. There's a lot of uncertainty what the FOMC is going to say during the press conference. That's going to affect volatility. Okay, low volatility again is good for investors because they want stability. High volatility is good for traders because we want that wider range. So, okay, stability means narrow range in a market, so price doesn't move much. Uncertainty in the market, there's a wider range, price move a lot, and it's as short-term traders, we want to take advantage of price movement. We don't really care about stability. But long-term investors, investing in Apple stocks, for example, you don't want Apple stocks to be moving like $100, $200 like Bitcoin, moving thousands of dollars every single day. That's not stable. All right. Market range again is dependent on the financial instrument. Typically, the equity market is pretty flat. Okay. Currency market, Euro, USD, dollar, yen is okay. It's reasonable. Sterling and sterling yen is a little bit wider. Bitcoin as a market, it's just way too volatile. Okay. So one of the reasons is that instruments with lower liquidity and market participant tends to be more volatile, and that is true. Not a lot of people are actually trading on Bitcoin yet, so that causes the lower liquidity, and that's gonna cause a higher volatility. We talk about exotic currencies. Not a lot of people trade exotic currencies. Therefore, it creates a lot of liquidity and it kind of tends to increase the volatility in that particular currency pair. Okay. Whew. All right, that's a lot to cover. I think we're done with the fundamental side. We need to rush through. We have about half an hour to go. We need to cover a little bit on technical analysis now. And as I mentioned on Wednesday, there are two divisions of technical analysis. Number one is price-based analysis. We take a look at that when we take a look at candlesticks. That is price-based analysis. And then the other side is indicator-based analysis. When I start throwing stochastics, for example, moving averages, those are indicator-based analysis. So you need to make a stand on which one you want to focus on first. Okay, price-based or indicator-based analysis. When we talk about price analysis, we take a look at trend lines, which is something I'm going to teach you guys tonight, how to draw a proper trend line, so not just randomly drawing a line. We can also look at chart patterns, which is something we're going to take a look tonight, which is the triangle patterns. Okay, we can take a look at Elliott wave theory, harmonic patterns. These are your Gartley's. You can also use Fibonacci based analysis. Candlestick patterns, we talked about this yesterday. We have a more advanced one called Renko. And then we have the Gann analysis. You got the Ichimoku Kinko here, which is reserved for the advanced one. So don't throw a question about Ichimoku right now. We don't have time to cover that. And then for equity traders, probably are familiar with this. Pivot levels play a huge role in terms of doing price analysis as well. Okay. Advantages of price analysis is that you are quick to react to price changes. That's number one. No ambiguity. That therefore you're working with the precise levels to work with. Indicator cannot give you a precise levels to work with, but price analysis is going to give you a precise level to work with. Precise exit levels are laid out, where your stop loss is, where your take profit target is. You can basically set and forget. Now the disadvantages is that there's not a lot of entries, and depending on the type of strategy you use, price analysis entry is mostly not optimal, because typically we rely on breakouts to happen. When breakout happen, typically the indicators are going to pick that up a lot earlier than price movement. Very high level of discipline and trading mentality is required, because you're working with an exact number. You have to follow the rule very tightly. If your trading strategy says get out here, you need to get out here. You cannot just stay longer than what you should than intended. Sorry. All right. Can be subjective if the signs are not obvious. Okay, so if we take a look at some of the divergences that's gonna happen in the market, you know, if you are not familiar with a technique and you're using it wrongly, for example, Fibonacci are typically drawn wrongly by a lot of people. Trend lines are drawn wrongly by a lot of people, then you're misunderstanding the rules, and that's going to give you a very subjective point of view in the market. Okay, so finally we're moving into the technical side of things. This is simple. This is a trend line, and it is not a random scribble on the chart. There are rules to follow when drawing a trend line, so don't underestimate trend line, because trend line is basically the basic foundation that you are going to need when you want to learn about, you know, advanced technical analysis going forward, if this is something you're going to pick up. Okay, so trend line, as it says, okay, my screen is flickering again. Okay, trend lines basically provide guidelines to price. Okay, it can be both a support or a resistance trend line. Most of the time trend lines are sloping, and the degree of the slope indicates the trend strength. The optimal, if you're going to ask me what is the optimal degree, it's between 30 to 45 degree. That would be the optimal trend degree. All right. So for trend line, a support trend line, which indicates an uptrend, you want to be looking for the low swings on the chart, and you want to connect the low of a swing and not the close of a period. Remember, we have the open, high, low, close in the candlestick. You want the very end of it. Okay, you want to have the very end of it. You want a low swings. Okay, you want all the swing lows, and not the close of a period. Okay, so a trend line must connect through 3 swing lows. This will indicate that there are more buyers than sellers in the market. Okay, so this is an example. I'm just gonna hide myself again. Okay, so take a look at how it's drawn. You basically need to have 2 connection there, and the third one when it connects to the third time, that means your trend line is valid. Okay, a valid trend line, which is your support trend line, once broken, it will become a resistance for the market. Okay, so let me get this. See how the market closed below that trend line, and then it goes up to test that trend line. Notice how it never break that trend line, and then the market tried to break it again until you have a definite close above that particular trend line. Okay, now for resistance or a downtrend, you want to be looking for swing highs on the chart. Previously we are looking at the lows of the candles there. We don't want to be looking at the close, but we want to look at the extreme low. For a resistance or a downtrend, you want to be looking for a swing high on your chart, and you want to connect these swing highs and not the close of the period. Also, a trend line must connect through 3 swing highs to confirm it, and this will indicate that there are more sellers than buyers in the market. Okay, so you can take a look at this one here. All I need to do is just draw 2 lines. Draw from 2 points. This one and this one, and then we wait. If the third one happens, okay, and got rejected, that means you have a confirmed resistance trend line, and it will come back to test it again in the future. So once you draw a trend line, you draw it correctly. Typically you use this trend line for a very long period of time, depending on the time frame that you look at. Okay, so we got trend line. Now we want to take a look at support and resistance, because trend line is just one form of support and resistance, because we do have a couple of other significant price level that will function as a support and resistance. Number 1, we have psychological price level. Just to touch on briefly, it's your 00, anything that ends with 00, 25, 50, 100, because this is how humans are conditioned to think. If I were to give you an apple, apple is probably not a good example. If I give you an orange, how are you going to cut the orange? You're going to cut it straight half, and then from that half, you're going to cut the orange into quarters. Okay, so this is the psychology of a human being. Everything is typically divided equally. Okay, so when we take a look at psychological price level, our mind tends to just round things up to a number that's easy to remember. If I were to say, 1.419, what does your brain say? Either you move it to 20, okay, or you move it to 25. If I were to say 1.403 or 1.02, you're just gonna say, oh, it's just 1.4, right? So anything that ends with 00, 25, 50, 75, those are your psychological price level. And then we have the Fibonacci levels, which is 23.6%, 38.2, so on. We're not gonna touch on that because otherwise some of you guys that are new here are just gonna get confused. It requires a separate webinar to talk about Fibonacci. Pivot levels as well. Some of you might have been using pivot levels or are familiar with it if you come from an equity trading background. But typically we look at previous failures or bounces in the market to identify key levels in the market. Okay, so this is an example of a Fibonacci level. I'm just going to show it to you, but you can see how price reacts to it. See how price gets towards those Fibonacci levels and fail, get to those and fail, touch this and just stop there. Okay, so it does play a huge role, but this is unfiltered. But if I filter it for you, you're gonna take a look at this in a different way, but we're not gonna cover that tonight. Okay, so we're gonna cover it separately. Okay, this is an example of a previous support and resistance. You can take a look at the 4 red circle there. That's where there's a failure that happens in the market. Market gets to that level, gets rejected, gets to that level, gets rejected 4 times, and then once broken, look at the blue circle. it goes back to that level, test it as a support before going up. Now, take a look at the number at the end there. It's 1.0525, okay, which is also a psychological number. So psychological number works like this, okay? It will act as a key support level. If you find 4 times market get rejected at 1.0525, then we expect 1.0525 to be acting as a support that needs to be tested before market can continue an uptrend. Okay, so this is another test. I just drew a trend line here, and when I draw a trend line at the very end of where that trend line connects, I'm just going to draw a horizontal line. This is how it's going to play out. The trend line exists, the trend line stands, market is still above the trend line. But what happens when market breaks the trend line? The first thing that it does is it finds support at the first swing low, which is the second line, the second candle that touches the trend line. And then it goes back up to that trend line, test it as a resistance, come back down, the final support horizontal line. Look at what happened to price. It comes back to test it as a resistance after breaking through it. Okay, so this is when we take a look at technical analysis and say, past examples or past occurrences are gonna happen again in the future. Okay, this is the basic fundamental of technical analysis. This is the basic fundamentals of price action based analysis. Okay, so we already talked about psychological price level, so I think we can skip this, but just do keep in mind that psychological price level is a very real phenomenon. Think about what I just said about the oranges. So keep thinking about the oranges right now. What are you going to do with that orange? You're going to divide it into an exact half and then an exact quarter. And then you're going to start from that quarter. You're going to cut it into another half again until you get maybe about 8 pieces or 10 pieces of orange slice, right? So again, support and resistance levels are going to be often found in close vicinity to these levels. So keep that in mind. This is just an example of how it works. Okay. Take a look at the levels I've drawn there. This is, take a look at it. 1.6950, 1.6975, 1.7, 1.7025, 1.750. And see how price reacts to those levels. It kind of stops, bounces off, stops, bounces off. Okay, this is what psychological levels are and how they are in play. So don't believe me? Take a look at your chart and start drawing a horizontal line on the 25, 50, 75. And double zeros, and you're going to start figuring out that there is a pattern going on there. Okay. Oh, that's a mouthful. All right, wrapping up chart patterns. So you guys are wondering, what should I do yesterday? Can you teach me some methods? Well, I'm gonna show you a chart pattern. This is the most commonly used chart patterns are triangles, patterns, your flags, and your wedges. We're going to talk about triangles tonight. So these are used to measure market sentiment, time and entry, detect reversals or trend continuations, and we are going to focus on triangles specifically. Okay, so take a look at this one here. This is just a compilation of possible patterns. We got your triangle, we got your flags, we got your triangle again, we got a broken trend line. Okay, but this is going to be found all over your chart, and if you can identify it, then good on you. That's the whole point of tonight's webinar, is to get you a jump start on figuring out these triangles. Okay, so triangles are formed by drawing the support and resistance trend line. That's why we start with drawing a trend line first, because if you draw a wrong trend line, your triangle is going to be wrong. Okay, if you didn't pay attention to what I just talked about during the trend line session, maybe it's good after this session to review this video again. Strengthen your trend lines on how you draw a trend line correctly, then you'll draw a proper and correct triangle. So there are 3 variations of triangle. That we have the ascending triangle, we have the descending triangle, we have the symmetrical triangle. Now, a triangle will always exist at all times, and it's identified through different time frames. So for example, there is a triangle on a daily time frame. The hourly time frame could be trading within that triangle, and then within the hourly time frame, maybe on the 15-minute time frame, there is a small triangle that exists. So we are typically kind of always under or inside a triangle or within a specific chart patterns. Okay, that's basically the knowledge that we see. Depending on the time frame that we look at, we might be looking at a different trend, but we are definitely within a certain chart pattern, and typically those chart patterns are triangle. Okay, so this can be used as an entry or exit to the market. Okay, so there are going to be triangles and patterns all the time. This is on the 15-minute time frame. Okay, you can take a look at some of the chart patterns here. We got symmetrical, 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 triangle. Okay, before the market breaks out, it forms a triangle first. Okay, so the range gets smaller, and then the market breaks out of that triangle and the trend continues. Okay, so we are going to start with ascending triangle. This is a bullish sign. This is commonly found in an uptrend, and it can only be found in an uptrend. So the market has to be going in an uptrend or an upward direction before it forms. Okay, this will signal a trend continuation. If you see this happen, then it's a trend continuation. You get a flat top or an overbought condition, but sentiment is still bullish, and buyers are going to continue to buy on dips. If you don't understand what buying on dips means, every time price falls back down, buyers are going to say, oh, that is a cheap price, I am going to buy it again. So every time it dips down, buyers are going to come in and buy it. Okay, this will again commonly occurs around psychological price levels, artificially capping the market horizontally, and this is what it looks like. Okay, you got your ascending triangle. You can see how flat the market is. Market is unable to penetrate higher, but look at the lows. It starts closing the gap because every time it goes down, buyers are there waiting to pick up on it. Once price break above that horizontal line, you can see that the market just starts trending immediately. This is a continuation pattern. Okay. And if there's a failure to break above the resistance, it's definitely not a sign of reversal. It could be something else. Okay, but when you see an ascending triangle and it only happens in an uptrend, you can already see here the market's already moving up. Okay, and then ascending triangle happens, then the market breaks up above it, it continues. Okay, so if the way I look at it is this is a trend, this is a consolidation period. The breakout is when the trend continues to go on. Okay. Next, we have the descending triangle. You can obviously see that this is the direct opposite of it. It's bearish. It's commonly only found in a downtrend. It signals trend continuation. Flat bottom means oversold condition. Sentiment is still very bearish, and buyers continue to buy on pullback. So instead of sellers continue to sell. So don't mix it up. This is a typo. Sellers continue to sell on pullbacks. Okay, so every time market goes up, sellers are going to come in and push price back down. Okay, again, this is going to happen around psychological price level, artificially supporting the market horizontally. So this is an example here. Okay, this is on the USD, the dollar basket there, but you can see the market starts going down. It's stopped by a descending triangle. It forms a flat line there. Market consolidates, break, and then it forms a symmetrical triangle, which we're going to talk later on. Drops down again, and it goes flat, consolidating flat like this. Again, this is a descending triangle. It's a continuation pattern. Okay. All right, next, it's a symmetrical triangle. This is what we call a neutral triangle. This is signifying indecision in the market. Buyers and sellers has equal strength. Range will gradually get smaller, and a lot of people don't like this. That's why the range gets smaller. Okay, when a market is moving in a small triangle, we typically see a drop in volume and volatility also. Most of the time, as the previous example that I showed you, the original trend will continue, but due to the nature of the uncertainty, this can also be a reversal point. Okay, so if I go back here, you can see the middle one there. That's some symmetrical triangle. Typically, the trend will continue, but it could be a reversal as well. Okay, so this is what a symmetrical triangle looks like. If you draw a horizontal line that, a trend line that goes up, you see a resistance trend line that goes down. Eventually, it will meet at a single point, and that's your symmetrical triangle. Where it ends, where the two line ends or meets, that's the time limit of a triangle. Okay, so market is eventually going to continue out of a triangle. It's basically just a limitation, a short-term limitations to price. Okay, when you see a market moving in a triangle, that means it's doing a consolidation, or it's consolidating, or it's doing a correction, depending on what you want to call it. Okay, so this can appear anywhere in the trend. Doesn't have to be a downtrend, doesn't have to be an uptrend. It can be anywhere in the trend. It can be any time, or whether it's consolidating, it can just appear. It basically means that consolidation is happening and there is a market equilibrium. Buyers and sellers have equal strength in terms of sentiment. It can be a trend change, or it can be a continuation in the market. Okay, so just a little bit of a summary before we start going to the Q&A. No, I think we do have a few things to cover before Q&A. But anyway, triangles are one of the best trade entries based on price. The momentum during the breakout will almost always move in one direction because it's a breakout, and being close to support and resistance during breakout, the risk to reward ratio is generally more favorable. Okay, if you want to dip your toes into technical analysis, the first thing that you need to master is drawing a trend line and then understanding how triangle works. And then feel free to move on after that. But these are the basic. This is your ABCD. Once you understand, you get a good understanding of how trend lines works, how triangle works, then feel free to move on to more advanced price-based analysis. Okay, even though you want to be using indicator-based analysis, have a good understanding of a trend line. Okay, and triangle is definitely a good thing to learn as well. All right, so some tips on trading triangles. You want to wait for price to break out of ascending or descending triangles. When I say price breaking out, means there is a candle close above it or below it. Okay, due to the logic behind profit taking and position adjustment, oftentimes price will come back to test support and resistance. You can wait for this to happen if you missed out on the first round. Also, the range of the triangle will always be the initial target of a triangle breakout. So if the range of that triangle is 100 pip, then your target will be 100 pip as well. That's typically how we look at setting a target using a triangle. Okay, so why does price action work? Because market movements are influenced by traders, simple as that. Okay, it's not dictated by anything. As a technical analyst, we believe in one thing, that everything is already priced into price. Okay, don't start an argument between a technical analyst and a fundamental analyst, because they have two different views on this saying. But market movements or price movements are basically influenced by traders. Fear of failure around psychological price level is a very strong influence because people pay close attention to those levels. Profit taking around these levels are also very common, giving an illusion of strong support and resistance. Instead, they're just actually taking profits. Okay, so if you buy, if you go long, or you buy Euro USD, for example, and you take your profit, what do you do with your buy? You actually sell your Euro USD. You might be selling around this resistance area, and a lot of people might, if they don't understand it, they thought, oh, people start selling, but no, it's actually just you taking profits right around there. Those are your target levels, and then you're waiting for a triangle breakout to happen before you start entering a trade again. Okay, so at the same time, some traders will still want to ride the trend, has a continuation once traders are assured that a certain level has been taken care of, right? So you come to a resistance level, you're scared that price might not be able to get out of that resistance, then it's not able to surpass the resistance. You want to take the profit first, that's fine, and then you wait until it breaks out, and then you enter long again. That's typically what happened around triangle breakouts. Okay, counter trend traders, on the other hand, hope for the flat horizontal level to work, therefore will go against the trend. I've stops line up just beyond those levels. Okay, let me just, oops, I got wait, hold on a second. Hold on a second. I'm losing. Okay, here we go. Sorry. All right. Breakout occurs because this stop accelerate price movement. One of the key levels that you can pay close attention to right now is on the GBP USD at 1.42. Okay, if you draw a horizontal line at 1.42, a lot of stop losses are lined up above 1.42. Just pay attention to it. Right now we're far off from it. I think we're about 1.38, 1.39. But if price eventually comes back to 1.42 in the future and you see price breaking above 1.42, you're going to see a sudden quick spike above 1.42 because a lot of stop losses are going to get taken out. Okay, so in summary, charting basically relies on past information to predict future support and resistances. There is no better leading indicator than price action itself because it's real time. Price takes into account trader sentiment and psychology. Charting also assumes that any fundamental views of the market is already priced into the market. The key aspect to successfully utilize chart information is to predict what others are thinking and looking at. Okay, not whether you are right or wrong, but whether other people are looking and thinking about what you're thinking about. Okay, if a lot of people are thinking about the same thing, then it's definitely going to be the correct way. Okay, so don't think you're right. You want to think how the market thinks. Okay, so every tradable instrument has very specific characteristics and price patterns. I'll discuss this in a separate webinar, but to give you a hint, the movement on the dollar yen versus the euro USD versus the pound USD, these are major currencies, but they have a different range. They have a different methods of when it comes to dealing with price action. They react differently. Okay, so if you guys learn chemistry, you know a certain chemical react differently to a different chemical. If you mix it around, it'll have a different reaction. Likewise, a currency pair is like that. You need to understand what you're dealing with because each of them has their own characteristics. It has their own life, their own personality, and they will act differently using when you use different strategies. Okay. All right. You can ignore the promo code there, but because we changed it around, if you subscribe to this, I think you are going to get a 100% deposit bonus, which Michael has been typing. But this is a Q&A session, so it's really full packed webinar tonight. So I'm going to go through the questions right now, and I'll answer as best as I can. Any questions that you guys have, please feel free to type it in. For someone who is not fluent in English, is mastering English language really important to improving trading capabilities? Not necessarily. A lot of materials are in English, but I think a lot of them are going to get translated to a lot of languages as well. But if you do understand the basic understanding, Albert, you're from Indonesia, so you have been attending my classes, right? You've been attending my sessions, so you actually get a lot already. So I'm gonna be there to help you out, so that's not gonna be a big issue. Okay, but a lot of materials are getting translated in a lot of languages. But yeah, if you have the advantage, good, because you can read a lot more sources. But otherwise, it's just price. Indonesia, how are you? Malaysia, how are you? Okay, I'm just going through the question, guys. If I keep quiet, that means I'm reading questions, okay? I don't think currency market has anything to do with UEFA championship. How you want to be a successful trader? Be a consistent trader. That's how you become a successful trader. Be disciplined in your trades. Thanks, Paul, for answering that. Discipline and consistency. Learn, practice, and trade. That's right. Practice and trade. Okay, practicing with Microlot is better than just staying on a demo account. It's a completely different experience. What are the cognitive and emotional biases that we should be mindful when trading? Don't overestimate yourself. I think that would be one bias that you want to avoid. Don't stick too much on your being right on your analysis. Sometimes you do have to make changes by reacting to how market moves to a certain price level or maybe a fundamental news. Calculating risk and reward, we already did that. The previous classes are already available on the OctaFX YouTube channel. Okay, account related questions. Which of the currency pair and time frame is best for beginners? Okay, for beginners, I normally stick to 4 currency pairs. That's the maximum, but I would start with 2, either the Euro USD or the Pound USD. Maybe the dollar yen if you want something less volatile, or the Australian dollar against the US dollar. That's okay, but typically you don't look at more than 4 currencies when you're starting out. Okay. If you can focus on one currency and learn the patterns, learn the characteristics, learn the range of that particular currency, and grow from there. How can we know when dollars is gonna start to go high? I just showed you. It's basically if the U.S. Treasury yield starts going up, then the U.S. dollar is gonna strengthen. That's one. Is MT4 down? I don't know. I'm not sure. Okay. Any manipulation from broker side? I get that question a lot. I work on a broker side as well. Typically, no, we don't want to manipulate your trade. Typically brokers have like hundreds and thousands of clients. We don't particularly hunt down a person. So that's just rumors going around, or what people that has been losing used as an excuse not to blame themselves, I guess. What is the difference between spread and pips? Spread is your initial trading cost, and it's measured in pips or price in points. Pips can be, calculated as the range that between your take profit target or stop losses. That's measured in pips as well. This meeting is gonna get recorded, Frederick. In terms of economic news, you can go to octafx.com website, and then under trading tools, there's economic calendar. You can look at that. Okay. How much can one invest? For demo, I don't know. I think you can set your own limit for that. If I just deposited around $25, what leverage is suitable for me? I think 400, 1 to 400 or 1 to 500 is suitable for you, because that's a very low equity. If you open a micro lot, it's gonna take, for example, on the euro, it's gonna take $6 away. Then you don't really have a lot of room to move. So be very careful. If I'm ready to risk 100, is it wise if I deposit? No, it's not wise for you to deposit just 100. You should deposit more if you want to risk 100. Okay, someone dah masukkan duit deposit 10,000. Good. Thank you. Okay, is it enough to deposit only $25? If you want to just try it out on a micro lot, I think that's okay. You want to play around with the market, you want to see how the market works, yes, but long term, I think you need to deposit more to see more of a significant gain. Can we trade, sell, and buy for the same pair? You can, but what's the point? You're going to be locked into a hedge, which is a perfect hedge, which is not going to get you anywhere. You only do that if you want to keep your position and you want to avoid, for example, non-farm payroll, and then release one of the position. That's okay. How to find a good position for taking profit on gold, because gold prices fluctuate very fast. Well, I think a lot of these technical analysis methodologies are going to work for gold. So that would be one way to start. When is the best time to trade for a person working straight 8 a.m. to 5 p.m. daily? Depending on where you are. If you can catch the UK Open or the US Open, that's going to be great. If you start in the US, then maybe if you live in the US, you work from 8 to 5, then you want to be looking at the Asian market. Maybe you want to be trading the Australian market. That's what a lot of US traders do. Okay. For some of us that cannot study how to trade, you can study to trade. It's just whether or not you want to study to trade. So that's a very different question there. You can study to trade. Whether or not you want to study or not, that's a different case. Can you get signals to trade? Well, you can try copy trading services, but that would be leaving it up to whoever trades or whoever gave that signal, whether they're right or wrong. Is COVID going to raise up again and make a new market crash? We already see that happen in 2020, early 2020. And I've shown this before. It only takes 3 months for the world to actually recover, the world economy to recover. Think about it this way, right? Jeff Bezos, Elon Musk got really rich during the COVID. So, and Bezos is basically doing their Amazon services. So, it doesn't really slow down the consumer spending if you think about it that way. The economic shock did happen, and it only takes 3 months for the world to recover. Sure, a lot of COVID cases are out there, but the economy is not shrinking at all. Okay, because people adjust, people adapt. What is the market open time? If you want to go by standard, it's GMT 00 daily. You are going to get a recorded session of this webinar. Okay. What's the percentage accuracy on the Telegram channel? I am not quite sure what you're talking about, but I believe the international Telegram channel is based on AutoChartist. All right. Oh, that seems to be all the question. All right, good. We are over time, but yes, thank you for attending. Hopefully, the 3 workshop here give you a good and deep understanding of how to get started in Forex. I know today's session is really jam-packed with a lot of information. It's going to confuse you, so I recommend that you review the recording again after this is done, so you get a better understanding on what you missed out or you want to dive deep into. And I know there's a lot of information to take in. I apologize if I just fry your brain there, but this is necessary for you to kind of get before you get started and get started trading properly. Okay. Thank you all for attending. Have a great weekend ahead. Stay safe, and I'll see you in future English webinars. So for those that want to start it out, feel free to sign up, and congratulations on your journey. Feel free to try it out. If it's for you, then stay tuned for more educational webinars on OctaFX YouTube channel. Stay subscribed. Any new webinars that's going to come up, you're going to get an email from OctaFX. I think that would be the best way. No, pattern for gold, oil, currency, and other trades, they're not really the same, because we can talk about correlation across assets, and that's some topic that we're going to talk about. Each of them has their own patterns. Thank you all for your time. We'll wrap this up for this week, Thank you for staying with me for 3 sessions of frying your brains. But going forward, we're gonna separate this into topical situation. This is a crash course thing, so it's not gonna be as crazy as this. Okay, so again, thank you for joining us at OctaFX. Hopefully, this has been beneficial to you. You guys get a lot of good information. Rebuild your basic foundation on forex trading or CFD trading, and stay safe. Have a good weekend. I'll see you in future webinars. Thank you all so much. Have a blessed